Okay, well, welcome everyone. My name is David Fulford, and I'm the CEO here at IPAC. And thank you very much for joining us for our webinar today on dealing the big issue of housing in our country. If you have a chance, could you please just use the chat feature? Let us know where you're participating from across our country. And if you have questions, please use the Q&A feature. We will have time for questions later on. Now, if you're anything like me, your inbox has been filled with housing issues. And recently at our conference in Ottawa, we were overwhelmed by the interest in this topic. So we've decided to bring governments together in a number of series that we're going to hold on this housing issue over the next year. The housing issue is not just about a place for people to live or an affordability issue. It's also critical for our economy. And IPAC is that unique organization in Canada that brings together all levels of government to collaborate to try and solve some of the wicked problems that governments are facing. Now, in this particular issue, of course, we know that there are many departments at all levels of government. It could be infrastructure, finance, education, for trades, immigration, transportation, and many others. So to bring this all together and to have a discussion about it today, I'm pleased to introduce our moderator, Martin Joyce. After Martin has had a chance to introduce the other panelists, we're going to go through a series of discussions. And please remember that there will be an opportunity for you to ask questions, so put them into the Q&A feature. Thanks so much, and Martin, over to you.
Thanks, David. Much appreciated, and welcome to everybody as we begin this discussion this afternoon. And the reason why we're having this discussion is the notion that housing has become such a big issue that maybe we need to rethink how we look at it, how we plan for it, how we fund it, and obviously how we build it in such scale to try and resolve one of the biggest social policy issues that we're facing at the moment. And so today we have three panelists from across the housing spectrum. One thing that they all have in common, though, is that they've been involved in direct delivery of building and constructing housing previous to their current roles. And I think that's important here. It's easy to say we need 3.5 million homes to close the gap. It's another thing to try and build 3.5 million homes really quickly. And it may take a different approach and change thinking in that process. So I'm going to ask the panelists to introduce themselves, and then we're going to take some opening remarks from them. And then we'll get into some discussion and some questions along the way. And feel free, as David said, to use the chat. And then there'll be time at the end to continue with questions of the panel. So, Katie, hoping you can introduce yourself first. Yeah.
Thanks, Martin. Absolutely. I'm Katie Maslechko, and I'm joining from Vancouver. And I am the CEO for BC's Rental Protection Fund. So we are effectively, as Wells may be familiar with, Canada's first NOAA acquisition fund. But for those of us in Canada, which is most of our audience today, we are have $500 million that was funded currently from the province, but with plans to grow to source private capital as well, to secure existing affordable rental supply, move it into the community housing sector, so nonprofits and co-ops primarily, so that it can move into the community housing sector, remain affordable, but also become a really important tool, asset, and piece of leverage for our community housing sector to really play an even bigger role in the supply side of the equation. So fundamentally, we're kind of a new approach to looking at how we secure housing supply, let's say, because the reality is as Martin was alluding to, if we're going to build 3.5 million homes, we might want to start also by ensuring that we're not losing 4 homes of the ones that we've already built for every new one that we're building. And so that's what we exist to do, is kind of plug the hole in the bottom of the ship, and also use that as a tool to leverage additional players into the supply side of the equation. Prior to coming into this role, I worked on private sector development primarily residential affordable housing, but also life sciences as well, really bringing the life sciences economy to Vancouver prior to joining the Rental Protection Fund. So looking forward to joining you all today.
Thanks, Katie. Wells, I'll get you to introduce yourself now. Just before you do that, I just want to say a big thank you because you are based in Los Angeles. It is a public holiday and you have dedicated some of your time today to us. So firstly, a big thank you and much appreciated.
No, it's my pleasure. I'm very happy to be here. So, and joining you all. So, I am work for the Los Angeles County Transportation Authority, which is I'll talk about a little bit later, but it's a very large agency, second largest in North America. And what the program I run is actually a housing program. So I'm not a transportation planner or transportation builder in any way. I run a program we call joint development, which is where we deliver historically, commercial mixed use properties, but now we're focusing entirely on housing. Before that, I worked for the city of San Francisco for then Mayor Gavin Newsom, running a 500-acre redevelopment project on their southeast waterfront. And I did want to just flag, I'm also on the board of LA City's Housing Authority, which has a huge portfolio, about 75,000 units, using a variety of mechanisms. And that's one of the pieces in the United States and in California. There are so many different ways we try to solve the problem, I think to our detriment. So Housing Authority is immense amount of skill in assembling all the tools in the toolbox and delivering at all ends of the housing need spectrum. So that's the background I'm coming from. I have worked in the private sector. I was a consultant for some time, both first for an urban design firm and then for a real estate market analyst.
Excellent, and welcome, Wells. And lastly, Deanna, I'm hoping you can introduce yourself and then we'll get underway with some opening remarks. Thanks, Deanna.
Thanks, Martin, and thank you for the opportunity to be part of the panel. So hello, everyone. My name is Deanna Veltri. I'm a senior manager at Deloitte Canada, and I sit within our public sector transformation team. In terms of my background, I spent the last 10 years of my career partnering with public policy decision makers to make sure our public services run efficiently, smoothly, and with Canadian people at the center of what we're doing from a delivery perspective and a policy-making perspective. Broadly, this has included work across human and social services to make sure that Canadians, regardless of their socioeconomic status or income, have a chance to prosper. And that goes all the way up to the middle class, all the way through to those more vulnerable Canadians who need support. Very specifically for this call, I am a loud and proud houser, housing wonk, housing nerd. My roots are in community housing. As Martin mentioned, I started my career in the community housing sector in Toronto, so developed a deep kind of passion I can't shake for this industry. And since then, I've had the privilege of working with everyone from federal and provincial ministries, small and large towns and cities, supportive and nonprofit housing providers doing that great work on the ground, and even work with private development industry to make sure our processes and policies around housing are effective and aligned with what the rest of the world is doing and when they're doing it right. In terms of my perspective, I firmly believe in the potential of government and that we do have policy levers to make change. Call me crazy if you want, but I truly believe that. And that's why I think this panel is important and I'm so lucky to be part of it. To have IPAC, its members from across Canada's public service all coming together to talk transformatively about housing is not something I've seen in my 10 years in this sector, more than I've seen it now, and it feels very groundbreaking. So thank you for having me here. I'm here in my consulting capacity, but again, bring really deep roots in the public sector and very excited to have this conversation today. Thanks.
Excellent. Thanks, Deanna. And before we get underway with some questions, I'm going to give each of the panelists a couple of minutes just to give a perspective on the notion of thinking through housing as infrastructure, as opposed to the way we think about it currently or the way we plan for it, which is a bit piecemeal. And if we thought about a city and if we thought about a country and in terms of their infrastructure needs, and we look across different forms of infrastructure, we take a very long-term view, both of the planning of it and the funding of it, and the building of it, and the maintaining of those assets and infrastructure. And Katie, I was wondering if you had a perspective on why we should think in a slightly different way and more long term on housing compared to what we currently do?
For sure. I think the way I like to think about it, or if you'll indulge the metaphor for just a moment, when it comes to preservation, is thinking about housing as though it is infrastructure, not just as infrastructure. Because if we were to look at the roads we've got everywhere, we don't, just when the road gets old, we don't scrap it away and start building the city in a different direction. You know, we build and repair that road, but we also need to build new roads as well. Otherwise, the city doesn't grow and it doesn't densify or it doesn't expand. And so it's much like roads or any other form of major infrastructure. It needs to be a both and scenario rather than an either or. Otherwise, we're really never making those meaningful strides, or it's arguably not the most efficient use of public dollars either when it comes to the really very real, very sizable challenges that we're all facing when it comes to housing or countless other issues.
And Wells, you have an interesting view of from an infrastructure perspective, because you do sit within the second largest transport infrastructure operator, builder, construction arm within the United States. And I was wondering if you've taken or seen parallels between how they plan for the metro and how you would plan for housing within your role.
Yeah, I mean, we are learning. So I do think we have benefited from the planning for infrastructure. So we have a $160 billion construction program right now, building out 11 new rail lines across LA County, which is a big area. So we, I think it's natural to think at scale for Metro. And I think both on the financing side, on the planning side, and even the community outreach side, if you think about it, there's, I think, 276 neighborhoods in LA County, 88 cities. So it's just, we're very dispersed. And so if I think about one of the biggest challenges, I think, for all of us is addressing the problem at scale. And even the program I'm running, which is ambitious for what we're doing, and it's groundbreaking. It's only 10,000 units of a 500,000 unit problem we have in Los Angeles. So I think being able to operate at scale does give some inherent advantages. And, like any bureaucracy, there are some disadvantages. But I think that having the perseverance and knowing that you have to keep your eye on the goal and that you have to bring all these constituents along with you at every step of the way is probably the most important thing that we have going for us right now.
Excellent. I'm going to come back and I'm going to ask some questions specifically about what you're trying to do and what led to it and what you're hoping to achieve. I'm going to shift slightly, and I apologize to you, Wells, because I'm going to take a Canadian politics question, which you can feel free to answer if you like. But I'm going to ask Diana this question first. Yesterday, we had the fall economic statement. It was released on Tuesday. There was a focus on housing. Any initial reactions or thoughts? Anything groundbreaking? Hit the mark? Miss the mark?
Yep. Absolutely. Happy to.
As controversial as you need to be.
There you go. I'll do my best to acknowledge what's good, but not hold back a little bit. So it's short, it's sweet, it's focused. There's still a lot to digest in there, but I've kind of boiled down. There's two things I like, something it left me longing for, and some things that maybe concern me. Concern might be a heavy word to say, things that leave me asking questions. One thing I really like, the use of the term infrastructure and housing many times in the same sentence. I personally haven't seen that before. The federal government is committed to launching a new department of housing, infrastructure, and communities. So specifically articulating this idea of the federal role in housing as an infrastructure priority. And there's also mention of tying federal infrastructure dollars to housing activities provincially and locally is a pretty exciting evolution. And it signals a pretty strong shift in mindset from the federal government, even from a few months ago when we heard the Deputy Prime Minister mention that at that time, there wasn't the perspective that the federal government was responsible for housing. And if you read the economic statement, there's a very direct statement that they are leading this effort. So very encouraging, set some nice groundwork for where we think collectively we need to go. So very exciting. That's one thing I like. The second thing I like is, despite being trapped in, admittedly, what's coming to be a political cycle, this wasn't just a marketing document for work that's already being done. They do, of course, mention existing programs and policies that are in play and talk about the effectiveness of those, but there are net new dollars announced here, in addition to dollars that have already been allocated. There are historical dollars being allocated to co-ops and community housing for an extended period of time. There are historic policy changes related to mortgages that, again, are really important. And we see more effective alignment with provinces and municipalities on short-term rentals. So we know there's no silver bullet to housing. We all say that very often, but to use this metaphor lightly, there are lots of lead, clunky, reliable bullets that we could put in the gun. I hate using this metaphor, but if you can bear with me, that we can start moving things forward. Martin, you asked her, is anything itself transformational? My opinion is no. Many tinker around the edges and are steps in the right direction, but I think that's okay, cognizant of where we are at politically and when we are desperate for anything moving in this direction. So that's what I like. What I'm longing for are some targets and their associated sticks and carrots to deliver. We say we need 3.5 million homes. Where and why in those places? What kinds of homes? Do we need rentals? Do we need single family homes? Do we need transitional homes, supportive homes? And in what time frame, based on political, demographic, and economic trends? We need a really clear vision. I don't know if a fall economic statement is the place necessarily to do that, but I do believe with this sort of groundwork, that's the direction that the sector needs to be focused on their efforts and putting our energy in the right places. The last thing we need is housing supply that doesn't actually put roofs on people's heads and doesn't actually solve the crisis we're facing. So that's something I'm really longing for, and we see in other jurisdictions. And then what concerns me? Two things. One, not related to housing, our economic outlook is a little nerve-wracking. We have low growth coming. We have a deficit that's going to grow better than maybe we thought it would, and maybe we're going to avoid a recession. So I acknowledge all that potential good or potential positive direction, but that is nerve-wracking, and you wonder how this will eventually or could eventually impact the work we do in this sector and the ability to make good on commitments. And funding isn't until 2025 in a lot of these cases. A lot of these announcements are a little down the way. And I don't have a sense in the fall economic statement if that's true, what's happening now. When we think about the Housing Accelerator Fund, for example, I remember hearing a lot of feedback that municipalities had to mobilize quickly and maybe didn't have the runway to be of the capacity and readiness to prioritize new projects, get their processes up to speed and ready to adopt this big wave of funding. So I wonder what's happening in 2024 to get the housing system ready for this onset of funding in 2025. I don't know if it's a concern. I assume our federal counterparts are thinking of this, as well as our provincial counterparts. We see lots of good work happening across the country, but that's something I didn't see when we talk about 2025 funding. So hope that's helpful. What I like, what I'm longing for, and what I think is still yet to be seen.
Excellent. Thanks, Deanna. And Katie, just to give you a chance, a quick view of what you thought, if there was anything in there, particularly from remaining assets staying within the system from an affordable perspective.
Yeah, I definitely agree with a lot of what Deanna shared, in particular because, the state of our economy right now and things being where they are, I do think just across the board, but certainly with the fall economic statement, this is a really rare, if we want to call it that, or unique point in time opportunity to kind of make targeted action or influence on areas, whether it's of specific need or specific gaps, because we're in an environment where to make things happen, it's about activation, not constrain and slow down. And are we managing things to focus where we want them to go? It's about everything is being challenged, and we have these opportunities to really quite directly turn levers. And so the nibbling around the edges does feel a little bit more frustrating, perhaps, than it would have otherwise, because there is an opportunity there that doesn't always exist. And the reason it exists is because it's needed now more than ever. I certainly, kind of on behalf of the community housing sector, I think it could have been a little bit more full spectrum. We need every actor in this equation being able to kind of step up and help solve it. And I think that could have been a little bit more of a focus, whether not specific to community housing, but just across the board, activating private, public, nonprofit community housing across the board. And I really do agree. A lot of it is flowing way too late, and I'm not really sure what that means in the meantime. And I think we're all kind of waiting to see what that will entail.
Excellent, thank you. Now, Deanna, just returning to you, if we think about housing as infrastructure, I was wondering whether you had any characteristics of what that might look like, what that would entail, any examples of where others have thought about this in this light that you could share with the participants on the call.
Absolutely, absolutely. I'll start with in a recent point of view that we put together, Martin and I, on this topic of housing as infrastructure. It involved a bit of research to your point, Martin, about how we do this right. We derived 3 broad ways or 3 critical conditions for success, regardless of where this is happening. And then maybe I'll zoom in quickly and talk about some specific examples. So those 3 kind of critical success factors of the way this works is if we adopt truly whole of government, so the entire government is involved at all levels, and I mean whole, truly, whole of system, so outside of government, we're involving all of those primary and secondary players in housing supply and managing housing demand, and a whole of country approach. So taking a national view that empowers local and provincial governments to do what they need to do. And so that's the whole of government approach. That's one critical success factor. The second is looking at supply and demand. We're talking a lot about supply right now. That's a huge piece of the puzzle, but it's good to hear about discourse around the demand side. How are we thinking about our population trends, where people are living, where they're going, and how are we building public policy decisions on housing around that? And the third would be setting clear and objective targets that introduce a new degree of governance, accountability, and incentives that doesn't really exist right now. So those are kind of those 3 broad categories of success. And when we look at it in places that this has worked well, if I really boil it down, it's come down to collaboration and clarity. So achieving those 3 things through those 2 principles. From a collaboration perspective, I mean contractual, binding, multi-year partnerships on the housing or growth topic. So these are explicit, they are multi-year, they persist beyond a political cycle, and have very focused and specific commitments made at all levels, leveraging all their various policy levers to drive towards a singular common goal. And these formal collaborations, they keep not just those primary stakeholders accountable for delivery and actually tied to something real, but it creates this incentive for governance that we don't always see. And governance can sound like a buzzword, but really creating the conditions that we start bringing in more of those stakeholders or system players we may not have in the past, like community housing providers, like the broader human and social services sector, who take care of many of the people who are living in different types of housing, like the transportation sector. So we're all learning and growing with each other. So that's the collaboration piece that's really working. And I'll mention some places in a moment. And then the clarity side, the other terminology I used, that's those targets and vision. These jurisdictions have come together and set a full and fulsome and future-focused vision they're driving towards, typically around growth with housing as a key part of that, but are very specific. I won't speak for Wells, but when I hear a title like A Home for Every Californian, that's a direct vision that can trickle into a lot of really direct actions that can involve a lot of really important players. So if I boil it down, Martin, collaboration and clarity are really important. Places we're seeing this done really, really well, and you'll be happy to hear this, Australia. The concept of the city deals, I encourage people to look more into those. Those are really deep long-term agreements that are tailored to each city, and city actually applies to a much broader region. Don't think of a city as one place. And really fosters that level of engagement in the housing and growth issue. And I also like to mention municipal planning organizations, MPOs in America. Again, every structure comes with its own challenges, but that's another example of an explicit, organized way to foster cross-regional approaches to growth and planning, and that do their best to avoid maybe the traps and the bureaucracy that slow things down by bringing all those thinkers into one room. So if I boil it down in those places that it works, it's collaboration, it's clarity, it's a clear path forward, and a clear way of working together to get to that path forward, Martin.
Well, as Deanna just mentioned, LA or California with a very ambitious goal, and I think your shortfall in LA is 500,000 units at the moment, and I'm going to assume at some point that's going to keep growing as the population keeps increasing, and we, struggle to build that quickly. You have a very interesting view. You sit within a metropolitan transport organization with a mandate to build housing. Can you just give us an overview of what led to that and why did Metro or LA Metro want to get involved in this, particularly housing?
Yeah, well, I would first say I think it speaks to some of Deanna's points, which are the housing issue affects everyone, and so the need for collaboration is sort of obvious. I think it's the next step of setting those goals and getting beyond the sectors. Truly, for Metro, getting involved was a matter of the fact that we lost some leadership in this space in California around 2012 when the governor dissolved what were then tax increment finance authorities statewide. Those were the authorities that were fundamentally bringing the most juice to affordable housing in California. And the crisis at that time, of course, was already worsening. And so that was definitely going the wrong direction. So the Metro Board, which is incidentally comprised of the same board of supervisors that control the county land use system, saw an opportunity for Metro to take leadership because they did have this experience that I talked about earlier of organizing around the mega projects. So with 11 rail lines under construction, I mean, these are big, multi-billion-dollar projects, tunneling, heavy rail, et cetera. They did realize that we can do this, and so they brought a ballot measure forward, which created a new sales tax to fund that transportation system, but it also funded a transit-oriented communities program, and that program came with a robust set of policies. And one of those policies ultimately that came to the fore is taking this joint development program, which has been around for decades, but mostly focused on traditional community economic development activities. We have hotels, we have the Hollywood and Highland Centers where the Academy Awards are held. Those are some of our projects, but now we're looking at all affordable, and we positioned our portfolio to look at every single site that we own, and we acquire those lands, by the way, through rail construction projects. When you're building rail, you need to buy land for laydown, et cetera. Those become sites for housing. And we created a new policy around it. So in 2021, our board set a goal to grow the portfolio to 10,000 units by 2031, so a 10-year horizon. And for those who are in the development space, I think a lot of us, we know that actually is quite a narrow timeline, because when we looked at our projects, it took us 22 years to deliver 2,200 housing units, unfortunately. And each of our projects was taking well over 10 years each, between the community outreach, the planning, the entitlements, financing, lining up all those sources for affordable housing, and then actually constructing the units and cutting the ribbon is a 10-year cycle. And we just knew we couldn't do that anymore. And so back to that collaboration piece, I think the thing that has enabled us to take this stance and do this, take this move is there is starting to be collaboration across the state, and particularly among the state legislature, which has taken a strong stance around building affordable housing around transit. And to the extent that they are overriding local land use authority in certain cases, and not a popular thing to do. And one thing I have observed from afar from this side of the border, I feel like Canada has a lot of built-in cultural support for working collaboratively. And California, I'd love to say we're collaborative, but a lot of it really was top-down because we just couldn't economically sustain the failure of our housing system any longer. And so having done that, the zoning laws have changed, which allows for a drastic streamlining of a lot of our projects because we are building affordable housing around transit. So suddenly, whereas we were waiting for developers to entitle their project for 3, 4, 5 years, they were always getting sued under our environmental law. Now they were moving much more quickly, at 6 months and below. So the focus was on us to accelerate our program and our process. And that's essentially what we've been doing to achieve the 10,000 unit goal. So the spotlight is turned back on us to really deliver and get those properties out there, get them under contract with developers and get them built before 2031.
And before I talk about the financing piece, Wells, 10,000 in 10 years or so, or we're a couple of years into that now. I'm going to, let's assume you're going to meet that goal. Are you taking lessons from building mega projects and applying them to the housing projects?
Yeah, I mean, one of those lessons is a little bit about having the stomach. I mentioned the constituents. You're working with those constituents each along the way. We've been very, it's not popular to say this, but we have followed probably pretty traditional planning methods around community outreach. We had a lot of workshops with microphones, and people angry would get up to them and, and raise issues. But we haven't done a great job of identifying the kind of larger body of support for housing. And it's similar to transit in that way. Bringing a new rail line through communities can be a very disruptive event in a multi-year, decade plus construction effort. So knowing that you got to keep your eyes on the prize and get to the goal, and also bring the constituents along, I think that's a skill set that has infiltrated our approach that is hopefully going to make us successful.
Katie, just turning to you on the financing piece. You do have a fund, you are purchasing assets, you want it to be a long-term fund, and you're hoping to attract different forms of capital. If we thought about infrastructure as an asset, it does have a different risk profile and a return profile for investors, institutional investors, versus a residential investment, which has double-digit return profiles because of the view that it's a bit more risky. But if we were to attract different forms of capital, what would it take for a long-term investor to get into housing in the realm of infrastructure? What would need to be true in the financial incentive framework for that to occur, so that you can take your 500 million, for example, and turn it into something more for the community housing sector?
Yeah, I'm always a little bit envious when I talk to some of my friends and colleagues working down in the States, because for years, decades even, they've had all these tools to first incentivize private capital into affordable housing in particular, but also into areas of particularly high need or neighborhoods that deserve and need it most. And we really don't have that same approach up here, or not with the same sort of tools. But I think what was exciting to me, amongst the many things that we're kind of doing through the fund, is that we don't really have a vehicle up here for private capital to directly drive into affordable housing. A lot of us would probably say it's inclusionary zoning, and I don't think that's quite the same thing. And so this is an opportunity where we can shape a new tool, and where that tool can be pooled and leveraged that much further, because there's an immense amount of interest in doing so. But when we're all also trying to deliver supply, or we see a lot of interest from foundations and social impact investors who are very much wanting to, or obligated to spend those dollars and looking for places to put them. And particularly now, as things are slowing down, a lot of the other projects that may have gone forward may have included a component, may have been something that they were looking to participate in. A lot of those aren't going forward, but it's really where leverage is the name of the game, and the magic tool in there. But it's also where I look at the asset value moving into the community housing sector, or frankly, the infrastructure that already exists, moving into the hands of new players into the equation. That's also a really powerful thing. Because rather than projects needing to involve, these deeply complex but really important partnerships, and perhaps it means the nonprofit selling off all or a component of the property they do own in order to participate in something bigger. You know, now they have that that independence, that bench strength, that financial bench strength, to move more independently. And it doesn't mean those partnerships don't happen. It means those partnerships happen at an even bigger scale going forward. And with preservation, it's happening that much faster. We're not waiting 5 to 7 years for them to be able to do that. We're, you know, moving these assets in 5 to 7 months. And then they will do all sorts of wonderful things with them, without necessarily needing to redevelop those, although they very well may, you know, over the long term, if that proves to be what's right. So I think that's an important piece as well, is in this very financially constrained, challenging economic environment, what are the new ways we can look at financially activating the actors in the game?
One of the approaches, and Deanna mentioned Australia before. Now, Australia does have a housing issue, and anybody who's followed the media can see it has the similar issues as it does in Canada. What it does, though, is plan in a slightly different way and has a very long-term view of both infrastructure and housing development and development pipelines. The other thing that it's doing, to your point, Katie, is mandating different forms of partnership around the development process. And so if government, for example, is putting out land, it's saying that, yes, we want the private sector obviously to come in and do and redevelop it, but you need to bring along an affordable housing provider in some way, shape or form to be a substantial partner within that process. If you don't get to participate. The other thing that's happening is the equivalent of the Canadian pension fund, so in Australia it's superannuation, and now getting involved and investing into housing developments with fairly significant affordable components to it, because they do view it now as a 20 to 30 year investment and are happy to take 6 or 7% return on that investment over a period of time because of the stability of the asset. So they are trying to attract new forms of development and partnerships into this space. And Wells, there's a question in the chat, which I'm just going to turn to now quickly. I've got a couple of other questions I want to ask, but this one just came up when you were talking about, and I think it's relevant. With the concentration that you're going to put around transit projects, is there a risk that you are creating, as they say in the chat, slum areas? I would have termed that slightly differently, but that's okay.
The issue for us, it's a double-edged sword. So first of all, we are usually around our transit investment. So usually these are new stations that have opened, and what instead we're getting challenged of is that these transit investments themselves are gentrifying forces, that the public investment stimulates so much private investment that the communities are getting displaced. And there's real evidence around that. It's not that doesn't uniformly happen every time we open a new station. So part of our response to that is actually by having control of the land and building a mixed income or affordable housing project on that land, we are addressing directly as we possibly could, honestly, some of those gentrifying forces. Our transit-oriented communities policies that I mentioned also do that. They work with our 88 cities that are in our jurisdiction and work with them to implement policies that are meant to protect naturally occurring affordable housing and to create renter protection laws, et cetera, in those communities before we make the transit investment. It's very much carrot, because we don't have land use authority. We can't really be a stick. But those are the types of things we're doing really more to address the concern around the flip side, the gentrification. I don't think we control enough land in most of these areas to make neighborhoods one way or the other, to be really honest. But it definitely, is part of the story. There's one property we have that's 15 acres. And the way we do that is it's a mixed income property. We have some 100% affordable, some mixed income buildings, some commercial buildings, it's just kind of good planning practice.
Just while I've got you then, you've got a 500,000 unit shortfall in LA County and Metro's taking on 10,000. Why couldn't you take on more or be more aggressive?
I do think that there are some barriers still. Like I said, we're learning. So I think the number one thing that comes up, and this probably will resonate anywhere, is finance, like literally having the dollars available to address the issue. We're finding, to look at the U.S. system of funding affordable housing, it's a combination of tax credits, grants, private equity, debt. Usually you're assembling between 8 and 12 sources per project, and they're very complicated, competitive, arduous pieces, each that layer on their own deed requirements, etc., onto the properties. So it becomes incredibly complicated, and guess what? The costs go up. And we also, of course, have our prevailing wage and other labor laws and other resources, so the costs continue to spiral. We are seeing projects in our portfolio that are north of $900,000 per unit to deliver, inclusive of everything, total development cost. That's not sustainable, and that's actually our biggest barrier, is just trying to figure out how would we even create that much subsidy all in 8 years. We would suck up everything in certainly LA County, so they wouldn't be able to build anything else. So you see, the pie isn't big enough. Like that's kind of one of our bigger fundamental problems. The other kind of maybe on the more I mentioned the zoning. I think that mattered and really cleared the decks. So implementing that at a testing out those systems has been one of the better things to unleash this. But that cost issue, kind of going back to that, is one of the biggest issues. And one of the things I just wanted to kind of put not necessarily a plug, but an interesting data point, I think, is that the United States Department of Transportation has a loan program that historically they have used to create low interest loans for tunnels, bridges, roads, etc., things that generate reliable revenue that are investment grade rating. And so that is how a lot of the big mega projects in the United States get built, is through this program called TIFIA. The problem, to the earlier point of it, housing being everyone's problem, the federal government is now coming to us saying, we need you to somehow, as a transit agency, they're like late to the party, fix the housing problem. And so we would like you to use this low interest resource to construct housing, and there's lots of issues with it. But I just think it's interesting to see them bringing the U.S. Treasury to bear on this problem, which could be incredibly powerful to solving that barrier. If we could figure it out and figure out how to create a fund that would be investment grade rating, that could fund not just 10,000 units, but those that bring it to scale, I think would absolutely move the needle here and in all the other cities in North America that are suffering.
I love them to the federal government to call.
Yeah, maybe United States. Yeah.
Katie, I've got this question for you, and I think Deanna, you will also have a view on this. There's a question in the chat that just came up. We mentioned the partnership arrangements and where you can mandate different forms of partnership around the development in order to participate, depending on the objectives of what it is you want out of that. And there's a question in the chat that says, what do you feel about these policies that enforce partnerships with non-profits, which ultimately add to the cost of the project and diminish return on investment? Katie, any thoughts on how you feel about those?
I think they're all very incredibly well intentioned and have led to a lot of really successful projects and partnerships, and in turn growing the portfolios of several nonprofits. I think the likelihood that those are happening much in this current environment, if at all, probably pretty low, or at least that's, I think, what we see here. And it does come back to all of these policies that obligate that, require that, but then we haven't previously done anything to ensure that there's actually the tools existing in the community housing sector to actually be able to participate at the scale that we're asking to. I mean, you implement an inclusionary zoning policy in a single municipality, and all of a sudden you're looking to shift thousands of units into the community housing sector very quickly, but have not really kind of equipped them with what they need to be able to actually secure those units from the developers, whether that's at cost or even at a deep discount from the developer. And so everyone kind of continues to end up in between a rock and a hard place. And I think that was already starting to be the case. And as costs and interest rates and inflation have, spiraled the way that they have, I think it's just broadened that gap quite substantially, to where I think most of those projects perhaps weren't going forward all on their own, but that requirement is now also a part of that gap, or we were just putting a completely unfair burden all too quickly on the community housing sector to absorb those very, very quickly. And I think now this all has a trickle down effect too, because at least in most of BC, or at least the lower mainland, we become very heavily reliant on the development cost charges and things like that are generated out of these projects to deliver the traditionally defined infrastructure that goes along with them, and supports the cities. And now that's not happening either. And so it's this very dramatic trickle down effect that starts to get very concerning these days.
Diana, on the view of the partnerships and adding cost or reducing return on investment.
An excellent point, and one that comes up very often when we're in those conversations with the private sector. And one of the a good exemplifies how the turning housing into infrastructure isn't so simple. This is a market-driven sector and industry in force, and market players want to have profits at the end of the day, and that's totally fine. That's the world we live in. So when I think about these partnerships, I think kind of short-term and long-term, and it pulls a little bit on Katie's threads in her comments. In the short term, I think it's a calculated risk that government may want to take in the spirit of getting the right type of housing across the housing continuum. There are sometimes gambles that may or may not result in the profitability or the return on investment that the private sector stakeholders would hope to see in those partnerships. So it's a calculated risk that I believe government can take, with accompanying understanding of how they may need to interject and provide financial or any other type of support to make this partnership a little bit more viable. So there's that piece there. I also think in the short term for those partnerships, I think immediately, it's okay that it doesn't resonate with every developer and every person trying to solve the housing crisis. This is going to be a sum of its parts in terms of solutions. So if mandating that partnership right now means that those industry players who are interested in the good of constructing more housing that is affordable for everybody are the people that are coming to the table first, I think we should welcome those partnerships if they exist and make space for them, because I think it has a long-term positive impact as well. That hard work at the beginning, as Katie talked about, to build capacity and get nonprofits or community housing providers ready and business-like to be an infrastructure player, all that work in the short term may mean in the long term that return on investment gets better and better. Your community housing partners become more and more viable, more and more like you, if you will, as a private sector or profit-driven entity. So giving that chance for their capacity to build their own capacity is really, really important. And I think a risk worth taking, knowing that not every project will go well. And I saw a great follow-up comment on the Montreal example in the chat. Often you're right. If it's a partnership or paying a fine, often developers pay a fine. That's okay. Let's just make sure we're allocating the dollars to building the capacity of community housing providers and providing them with opportunities to become more business-like and build that bench strength that Katie was talking about, and directly invest into that sector if we can. And Martin, I know they do some of that, did a lot of that in Australia to build the capacity of community or nonprofit housing providers. So I think it's a calculated risk worth taking, putting it simply.
Well, if I can just
not to be too controversial on this topic, though, just Katie, before you at that point, we in Australia had a view that bigger housing organisations and less of them was the best approach because of the capacity and sophistication required in order to get involved in some of these mega projects. They haven't shied away from that over the last, I don't know, well, I ran an organisation for 3.5 years. So, over the last 10 to 15 years, that's the approach they've taken. That's the path they've gone down. And, in the country, there's probably 30 housing organisations that are of note, and everybody else makes up the numbers. But that's the Australian approach that they took to capacity and sophistication. I'm not advocating for that here yet. Katie, sorry.
No, I was just going to add that looking at preservation, I think, is also an interesting angle in all of this, because we're also used to solely talking about new development as the only tool in real estate, or at least in Canada. And when we're talking about risk profile, like these assets have been operating sustainably, although perhaps less sustainably in this economic environment, but that's what we're here with an equity injection for. But they've been operating sustainably and continue to operate sustainably for years to come with that equity injection, and that we're not needing to play this big double-digit return gamble, because it's very much a gamble these days. It probably always was, but it very much is these days. Very few developers are actually getting that return. It's what's necessary to buffer over that period of time, and that risk profile. And so to start to look at preservation, to start to look at the existing housing infrastructure we've got that's kind of proven its security and stability, and retaining it into any segment of the sector, quite frankly, is important, because we're also at risk of losing a lot of that stock, not necessarily due to solely redevelopment, which I think has also often been the narrative in this economic environment. I think disinvestment is just as much a threat, where very well-meaning owners are just getting stretched far too thin with their mortgages and other costs escalating out of control, and that a point in time shift in that ownership and equity injection can mean that supply stays in our supply at all.
There's a question in the chat that I'm going to answer, and it's in Canada, tax laws allow people who invest in second or more homes to deduct losses, etc., etc. The same approach applies in Australia as well. And I'm going to answer the question in this way. In 2000 and I'm going to say, I think it was 19. It may have been a federal election before that. Maybe it was 17. Australia's had so many prime ministers and elections, you kind of lose count after a period of time. The opposition took a policy to the electorate federally around that exact issue, negative gearing, as we call it in Australia, and lost handsomely. And that was the policy that, upon review, was the one that lost them that election. And it was an election they shouldn't have lost, to be brutally honest with you. What that now means is that entrenchment of that taxation is probably now another generation away before anybody thinks about taking it to an election. So I suspect that that's going to continue on in Australia, at least for the next 20 plus years, next 4 or 5 elections. I would hazard a guess that from a political perspective, it isn't the best policy to take to an election, and people know that, and they may shy away from that, unfortunately. I'm not saying I agree or disagree. I'm just giving you the perspective that they've tried to change it and it didn't work, and they've been burnt by it, and it won't come back. There's a question here, and Wells, you may have a view on this because of the program you mentioned about low interest loans for other forms of infrastructure. So in the chat box, there's a comment here that in Canada and Australia, you've had CMHC. Now we have Housing Australia, which was the National Housing, I can't even remember what the acronym stood for, but it started out as a green investment fund that turned into investing in climate change initiatives for housing, community housing, and then switched into the investment corporation, which was going to the market to aggregate debt for community housing providers. The question is, is there a way to improve those lending programs to accelerate the lending for these sorts of initiatives? And Katie, you're smiling, so you may also have a view on that. But Wells, you mentioned the one in the US. I mean, is there anything they could do better or differently to speed it up?
Well, I mean, what I mentioned was a transportation program, and I definitely have some thoughts on it. There are obviously federal housing resources, Fannie and Freddie, et cetera, that I believe have been changing some policies of late, allowing for that kind of aggregation, which I think has been actually a step in the right direction from a housing authority perspective. Has allowed us to lower our debt costs, which allows us to invest more. So that has been a really positive step. For this particular transportation loan program, which I can't tell you how through the secretary's office, they are so keen to get something done through this program, a TOD project. But I should note the capacity, I don't know the capacity of the program right now, but they loan on average, their loan scale is between 500 and $10 billion. So they're fairly large loans, and probably, to my earlier point, size for the scale of the problem. What could they do to improve it is kind of wonky. One is they require a national environmental review. That's something developers locally don't have to do, and so that's just yet one more hurdle for them. There's a Buy America provision, so when you're buying your HVAC units on those buildings, they can only be made in the United States. That's limiting. It's limiting when you think about elevators, escalators, mechanical, anything like that. And certainly and I firmly believe that the advanced offsite manufacturing is probably where ultimately this needs to go. There's even more complications around that. Yeah. And then the last piece that's the biggest hurdle is it sets forth this investment grade rating, which is a standard, that obviously is what they need to underwrite the program, but it is totally at odds with real estate, which doesn't run at that kind of rating. And so it ends up requiring so much credit enhancement locally that it's sort of, you lose the benefit of it. And to the kind of the gestalt of the bigger point here is like, this is a gamble the federal government can take. And so I don't know quite how to rewrite that, but it just seems like the risk potential and capacity at a federal or even state or local level is so much greater than is being translated into the markets for capital. And we are paying on all our projects, on any market rate project, we are paying those traditional private equity rates on the capital, and it just is killing the projects. So somewhere there's a solution in there that we really need to figure out.
I'm just cognizant of time. We are at 1 o'clock and people are dropping off. So I have a two-parter for you, Katie, to finish. The first one is from a government loan perspective, is there anything that they could do differently to help fast track any of that or scale it up? You've got about 15 seconds. And then finally, is there something at a provincial level that's being done differently as a success story that you want to highlight maybe?
For sure. I do think I'll empathize that, CMHC in a way has been a victim of its own successful programs, in that right now, one of the biggest challenges we're facing, or our applicants are facing, but countless others are as well, is that the processing time is just taking an overwhelmingly long period of time. At this point, 8-9 months, which definitely doesn't work with acquisitions, or at the very least, securing bridge financing in the meantime is just about wiping out, to Will's point, it's wiping out much of the benefit of those low cost or better term loans that are offered through CMHC. So I think they've got a lot of the right scaffolding in place. And perhaps just kind of segmenting or diversifying it a little bit into these targeted paths would hopefully help with processing time, but also having something dedicated specifically to preservation acquisition would go a significantly long way. And I don't think has to look dramatically different than, tools they already have. And so therefore, hopefully could be easy to adopt. And I think one of the reasons that would be very much worth exploring is because what BC has stepped up and done, and credit to our province for having the innovative foresight, for putting it in the hands of the community housing sector to steward it. But this is a very innovative model, and it's proving that it works. And we're getting a lot of interest from other provinces across the country wanting to better understand how they can implement a model like this, how they can have their own. and that this has the potential to exist in every province across the country. And so it's not only worth federally thinking about what they can do to incentivize that, but looking at what they can do to incentivize that, not to copycat it. We don't need this exact structure at the federal scale. We need the right tools in the capital stack, no matter where in the country you're delivering this model, to activate it and really make it soar. And in doing so, incentivize provinces across the country to step up and do the same thing, because from what I'm seeing, many of them are already willing.
Thanks, Katie. Now, I have to admit, I failed as the moderator. I've gone over time. It's 3 minutes past 1. I just want to thank you all, as Wells especially, for giving up part of your public holiday Thanksgiving, Deanna and Katie. I'm going to assume, Katie, that after that point on the way you run your fund, you may be getting some inquiries from other jurisdictions on that one. So hopefully you get overwhelmed with interest. And David, I'm going to throw it back to you to conclude and finish up after 1 o'clock. I apologize.
Yeah, no worries, Martin. Lots of discussion. Wells, I really like what you said about bringing all constituents along. Always challenging, but so important. And Deanna, I want more information from you around those targets, sticks and carrots, because I think that's so critical. And Katie, I loved your line. We need to bring every actor along to step up and help solve this. So thanks to our panelists. I know we have a number of questions that we didn't get to, so I'm really hoping that I can convince our panelists to put an article in our newsletter, IPAC Connects, that will be coming out in December. So it would be great. They're all nodding, so I'm assuming that's going to happen. Thank you to our audience.
I'm nodding on their behalf, David.
Yeah. Thank you to our audience for your participation. We will be having another session on housing, so please keep an eye out for that. And on December the 7th, we have our new professional event. I hope that if you are a new professional, you'll attend. And if not, if you have a new professional working for you, you will encourage them. It's just a half a day. We have some great speakers. So thanks very much, everyone, for joining us, and have a great day.